Hello everyone, welcome to lecture 2 of module 7. In the previous lecture, we have touched upon the introductory orientation of cash flow analysis and the preparation of cash flow statement, covering the usefulness, the significance and the limitations of cash flow analysis with regard to the protocol of analyzing the financial statement and leading to different financial decisions pertaining to the business organization at the end of the users community. In this lecture, we are going to specifically address the steps involved in the process of preparing cash flow statement within the ambit of cash flow analysis as a technique of financial statement analysis. In the previous lecture, I had just hinted about the steps which specifically accumulates different activities under three broad subcategories, namely operating activities, investing activities and financing activities. When you are going to prepare the cash flow statement, we are there to decompose all the activities getting executed in a business into three categories, and we are there to study the inflow and outflow of cash arising out of the performance of activities related to operations, related to investments and related to financing states of affairs of a company in order to better understand the status of liquidity of a company, and which is otherwise going to contribute significantly towards arriving at conclusions pertaining to the company, and also it is going to assert the future states of affairs so far as liquidity is concerned. Now, moving further, when you are going to talk about steps in cash flow analysis, it is designed in such a manner so that we are there to encompass all those activities which are related to cash or cash equivalent. To start with, the first step is calculation of operating cash flow or cash flow from operating activities. When you are going to talk about cash flow from operating activities, we are simply referring to the day-to-day activities related to different functions of a business that are executed at the end of the body corporate. Moving further, when you are going to talk about calculation of investing cash flow, essentially it accommodates the cash inflows and outflows arising out of investing activities, which simply reflects the acquisition of fixed assets, investment in other companies, purchase of non-current assets, similarly the sell of fixed assets, the sell of non-current assets and so on so forth. We are going to deal with this in a detailed way later on. Then the third step is the calculation of financing cash flow. It simply represents the cash inflows and outflows related to financing activities that are getting executed in the business organization. Why are we dividing the same into three distinct steps? It is simply because of the logic that we are there to better understand the flow of cash, either inflow or outflow, by decomposing different activities into different groups, because we all know that there are numerous transactions which are getting executed when we look at a large scale business organization. And if you are going to consider the cash inflows and outflows related to different activities of a large scale business organization, it may be in lakhs of numbers, and it is always confusing and complicated to study the inflows and outflows of cash in a totality manner so far as a company is concerned, when we are backed by the very objective of dictating and ascertaining the liquidity status of the company, and we are on the verge of arriving at decisions So, it is always imperative to divide the cash flows related to different activities separately and accordingly prepare the statement by considering one activity after another. To start with, in this lecture, I will be deeply dealing with the first step, that is cash flow from operating activities or operating cash flow concept. When you are going to talk about cash flow from operating activities, simply it accommodates all those activities related to different functional domain, either leading to expenses or leading to incomes, which are based on cash and cash equivalents. And we all know that majority of the business activities are getting executed on cash basis when we are going to talk about payment of expenses or generation of revenues. But why are you calculating this separately? It is simply because of the reason that the consideration of all these operating activities while preparing the financial statement, and specifically the trading and profit and loss account, which is one of the formidable statement within the financial statements. Over there, we are taking into consideration different activities which does not practically lead to any cash flow, but it is treated in the profit and loss account owing to the conceptual barrier, because profit and loss account is prepared on the basis of accrual orientation, whereas cash flow is based on actual basis and it is only taking into consideration the cash and cash equivalents whenever we are talking about an activity and its execution. So, here the concept goes that cash flows from operating activities indicate the extent to which the operations of the business have generated cash to comply with the requirements. In general, net profit leads to inflow of cash and net loss leads to outflow of cash. Here there is a cautionary approach. When we are looking at the financial statement, we all know that profit and loss account gives us net profit or net loss as the outcome of preparing the profit and loss account. But the question is whether that net profit, which is the outcome of profit and loss account, really reflects the net cash generated in the business. The answer is a big no. Why? Because there prevails different non-cash or non-operating activities which are finding a place in the preparation of profit and loss account, like depreciation, like loss and sell of fixed asset, like loss and sell of investment, profit and sell of investment, profit and sell of fixed assets, interest payments, blah blah blah. There are many. We will be discussing the same later on in this lecture. What are the different items that are coming under the purview of preparing cash flow from operating activities. Now, as an introductory orientation, we are there to know specifically that the net profit arrived at through the preparation of profit and loss account is not going to be the same as net operating cash flow from operating activities. So, there may be differences, and the reason behind such differences are the treatment of non-cash or non-operating activities in terms of expenses, losses, incomes and gains in the profit and loss account, through which we are ascertaining the accounting profit. So, under cash flow analysis, the financial items are treated on actual basis rather than on accrual basis, and by a change of this basis of accounting, obviously different items that are going to be accommodated while preparing cash flow statement will be different compared to the profit and loss account orientation. Moving further, when you are going to talk about the first step in cash flow, we are more or less inclined to quantify or to ascertain the cash inflows and outflows arriving at the business organization pursuant to different operating activities. But all these things have already been considered in the profit and loss account. So when you are going to start off with the calculation of cash flow from operating activities, we are there to start from the output derived from profit and loss account. The output of profit and loss account is either net profit or net loss during a financial year. Now, why are we going to start from that? It is owing to the simple reason that net profit which is arrived at by preparing profit and loss account is not going to disclose the true profit in terms of cash. So we are there to make all sorts of adjustments of different financial items which are non-cash or non-operating in nature. Either we are there to add or we are there to subtract when we are going to talk about the calculation of flow of cash emanating from operating activities. After making adjustments to all these items, we are there to go for the adjustment of changes in current assets and current liabilities and its impact on the cash flow related to operating activities. Now, let me explain the logic of treating current assets and current liabilities as well as their changes while calculating cash flow from operating activities. Simply, say for example, we are executing an activity of sales on credit. The outcome of credit sales is not immediate. Rather, we are allowing a credit customer say 15 days or 1 month time to make the payment. So, the date of execution of that sales activity and the date of realization of that sales activity is going to be different. Now, the moment we are creating a credit sale, our debtor is increasing, and the moment we are realizing cash from the debtor balance is decreasing and the cash is increasing. So, technically speaking, if there is any change in current assets or current liabilities, the genesis of such changes in current assets and current liabilities are somewhere or the other related to the execution of operating activities in the business. That is why we are there to make the treatment of current assets and current liabilities and changes thereof during a particular financial year when you are going to quantify the cash flow from operating activities. Here I have made a mention of some points which are to be adjusted while calculating the cash flow from operating activities. To start with, dividends. As I said just now, we are there to start from the output of profit and loss account. It is net profit. Net profit is after making all the charges whether it leads to flow of cash or not. But dividend is charged to profit and loss account, but it is not actually paid during that financial year owing to the prevalence of Companies Act, because dividend decisions are normally taken in the annual general body meeting of the shareholders at the end of the financial year. Say for example, the financial year 24-25, the AGM of 24-25 is going to be held in April 25. By that time, the profit and loss account has already been prepared and the dividend has already been charged and the profit has been reduced by that amount. But by charging dividend, the profit has gone down, but the cash would remain the same. There is no impact on the cash, owing to the simple reason that it is a non-cash item. So, like the next is depreciation. Depreciation is a book entry which is charged as a loss associated with fixed asset, but does not lead to any flow. The reason is it is a non-cash item, though it is operating in nature, but it is non-cash. There is no outflow of cash as a consequence to charging depreciation. So, we are there to add back all these items like amortization of fictitious assets. Say for example, the patent in the balance sheet previous year was given 50,000 and in the current year it has gone down to 30,000. So, obviously 20,000 of patent has been amortized during the financial year, but that is again a book treatment and it does not lead to any flow of cash. But as it is charged in the PL account as an expense, it has to be added back while calculating the cash flow from operating activities. Similarly, provision against current assets, say for example provision for bad and doubtful debts, that does not lead to any flow of cash, but it reduces the profit by the amount of charge. So, we are there to add back that amount. Similarly, profit or loss on sale of investment. Normally, the businesses, instead of keeping their surplus cash in idle state, they are investing those cash in different financial instruments of other companies or other financial institutions in the form of short-term securities, in the form of T-bills, in the form of commercial papers, and when they are selling it out, they may incur some loss or they may incur some profit, but whether they are arriving at any loss or reaping any profit, it has nothing to do with the operation of the business, because it is an investment made outside the business. So, it is falling under the purview of a non-operating activity which has already been charged to profit and loss account and need to be adjusted by adding it back to the net profit when we are calculating cash flow from operating activities. In the same manner, we can take into consideration provision for taxation, then transfer to general reserve, transfer to capital reserve, and all these things we are there to add and subtract, we are there to add all those non-cash or non-operating expenses and losses which have already been debited to PL account while calculating net profit. On the contrary, we are there to subtract all those non-cash and non-operating incomes and gains which have already been credited to PL account while ascertaining the net profit. Now, by doing so, we are there getting the cash flow from operating activities before changes in current assets and current liabilities. And in the starting part, I had explained the logic why we are there to consider changes in current assets and current liabilities while calculating the cash flow from operating activities. Now, after calculating the operating profit before working capital changes or before changes in current assets and current liabilities, we are there to consider individual current assets and current liabilities and their changes, and to adjust such changes in current assets and current liabilities using the logic. Now, the logic is, if there is a decrease in current asset, say for example debtor in the previous year was 50,000 and in the current year was 30,000. So, obviously it is clear from these amounts getting displayed in the balance sheet that 20,000 amount of debtor has been realized during the financial year. So, when cash is realized as a consequence to decrease in debtor, it is adding off to the operating cash inflow. So, we are there to add it back if there is a decrease in current asset. Similarly, if the inventory, say for example in the year 2021 the inventory is 5 lakh and in 22 the inventory has gone up to 6 lakhs. So, there is an increase in the amount of inventory by 1 lakh of rupees. Now, if we are there to dig out what are the reasons for such an increase, we will conclude that additional inventory has been procured during the financial year. When additional inventory has been procured during the financial year, that means there is cash used and committed to do so. Any increment in current assets is to be subtracted while calculating the cash flow from operating activities. Any decrease in current asset has to be added back while calculating cash flow from operating activities. Moving further, when you are going to talk about current liabilities, it exhibits exactly the opposite relationship with that of cash flow from operating activities. If we are witnessing an increase in current liability, say for example, the creditor in the year 2021 is 60,000 and in the year 2022 is 90,000. So there is an increase in creditor by 30,000. Now if there is an increase in creditor, definitely we are there to add that 30,000 rupees of increment in creditor while calculating cash flow from operating activities, owing to the simple reason that credit supplies from the creditor is utilized in executing the day-to-day activities, but we did not make the payment. So that is why there is an increase. So we are there to append it while calculating the cash flow from operating activities. In the same manner, if there is a decrease in current liabilities, say bills payable was 1 lakh in the year 2023 and 50,000 in the year 2024. So it is clearly an indication of the fact that 50,000 worth bills payable has been repaid. So when it is paid, obviously it is paid either through cash or by using the bank instruments. So whatever they may be, they are to be subtracted while calculating cash flow from operating activities. So by making adjustments of all these current assets and current liabilities individually by using the logic, as I said, decrease in current asset to be added, increase in current asset to be subtracted, increase in current liability to be added, decrease in current liability to be subtracted, we are there to arrive at the operating cash flow before profit, or we say the cash flow from operating activities. After calculating the same, we are there to finally subtract the tax liability in the form of income tax, and after deducting the income tax liability from the cash generated from the operating activities, we are ending up with net cash flow generated or used in operating activities, which is the outcome of the calculation of operating activities cash flow. The same can be explained with the help of a format. Here I have just developed a format for easy convenience. Format of cash flow from operating activities. To start with, we are there to consider the net profit after tax, we are there to add appropriation of profit. Appropriation of profit simply refers to the utilization of profit in different ways, say payment of dividend out of profit, then transfer to general reserve or transfer to any provision or reserve which is specifically created or created for the general purpose, that has to be appended and added back. Then similarly provision for tax, if any, which has been treated in the PL account, that is also required to be added off. Then after making all sorts of adjustments to net profit after tax, we are there arriving at the net profit before tax. Because when we are going to talk about operating activities and cash flow from operating activities, these items have nothing to do with the operation. Rather, when you are going to talk about tax, it is a tax liability owing from the government orientation. When you are going to talk about dividend payment, it has nothing to do with the operating activity of the business. Rather, it is the return which is paid to the share owners. It is the return paid to the stakeholders, nothing else. It has nothing to do with the operating activities of the business. That is why we are there to calculate the net profit before tax in order to practically ascertain how much cash has been generated as a consequence to the execution of different operating activities, or how much cash has been used in operating activities. Now moving further, we are there to add all the non-cash or non-operating expenses and losses. In the previous slide, I had already explained why do we add all these expenses and losses which are non-cash or non-operating in nature. Because the profit which is taken into consideration for the purpose of calculating the cash flow from operating activities, they are arrived at by making the treatment of all these items, whether they are non-cash or non-operating, because the profit and loss account is based on the broader concept of finance which accommodates all the activities of the business related to different functional domains, may it be non-cash, may it be non-operating. So, when we have already considered all those expenses and losses while calculating the profit and loss account and ascertaining the profit, obviously if it is an expense or loss, it has reduced the profit by that amount. So, by adjusting the same, we simply mean if you are going to add it back to the net profit before tax, the adjustment will be made so far as the cash flow from operating activity is concerned. Similarly, moving further, we are there to deduct all the non-cash or non-operating incomes and gains. The incomes and gains while preparing the profit and loss account have been shown in the credit side of PL account, and anything which is shown in the credit side of PL account is going to increase the profit ascertained through the profit and loss account. Now, these non-cash or non-operating incomes or gains have already been treated in the PL account, and it has already magnified the amount of profit which is arrived at through preparation of profit and loss account. So, as an act of adjustment, we are there to subtract all those incomes and gains which are non-cash or non-operating in nature while calculating the cash flow from operating activities. Moving further, after making all these adjustments, we are there to arrive at operating profit before working capital changes or before changes in current assets and current liabilities. We are there to adjust all the changes in current assets and liabilities individually. Just before I said, we are there to make the use and application of logic associated with current assets and current liabilities and its consequential impact on cash flow. Now, I had already mentioned that if there is a decrease in current asset, it is to be added. If there is increase in current asset, it is to be subtracted. If there is increase in current liability, it is to be added. If there is decrease in current liability, it is to be subtracted. By making all sorts of adjustments related to changes in current assets and current liabilities, we are there to ascertain the cash flow from operating activities. After ascertaining the cash flow from operating activities, the final item we are there to deduct is the tax liability, that is how much of tax has been paid based on the profit. Now, after deducting the tax, we are there to arrive at the net cash flow from operating activities or net cash flow used in operating activities. There are certain typical items which are also treated before the calculation of net cash flow from operating activities, like the extraordinary items like losses or gains arising out of movement in foreign exchanges. They are not regular items which are made available, because if a company is not exposed to cross-border transactions, the prevalence of all these items are not there in general. But when we are going to talk about the transnational institutions or the companies who are conducting business in different countries, they are definitely exposed to the movement in exchange rates, and any movement in exchange rate may lead to profit or may lead to loss. So, we are there to make the treatment of these items also over there before arriving at the net cash flow from operating activities. Now, I hope we have considered all those items, all those financial variables which are to be adjusted while calculating cash flow from operating activities in a scientific and systematic manner, and I hope it would facilitate the preparation of cash flow from operating activities in a cogent manner. Thank you for your patient hearing and attention.